Welcome to The Explainer. Today, we're diving into one of the most powerful and honestly most misunderstood numbers in the entire world of investing. So, what if I told you that by the time we're done here, you'll have a brand new lens for looking at the stock market? A lens that shows you what really drives the stock's price, way beyond all the daily noise and headlines. Okay, let's jump right in. We're going to decode the price-to-earnings ratio, the PE ratio. And we're going to do it by looking at one of the biggest companies on the planet, Apple. Now, on the surface, the PE ratio seems super simple. It's just the company's stock price divided by its earnings per share. Basically, it's asking a really simple question. How many dollars am I paying for every $1 of profit the company makes right now? But here is where it gets really interesting. If you just flip that simple formula around, something kind of profound just pops out. You see, a stock's price isn't just one thing. It's actually the product of two totally separate engines, the company's actual earnings and the PE multiple the market decides to give those earnings. Both of these engines can send your returns soaring, or they can completely wreck them. So, if the PE ratio is one of those two key drivers, what is it actually telling us? Let's really decode this thing. Right now, for Apple, a stock price around $200 and earnings of about $6.40, that gives us a PE of roughly 31. So that means investors are willing to pay $31 for every single dollar of Apple's profit. But why 31? Why not 15 or 50? Well, this is where context is everything. Look at a super stable company like Coca-Cola with a PE of 25. Then you've got Netflix, which gets a much higher PE of 45 because everyone's expecting huge growth. Apple at 31 is sitting right in the middle. This tells you the PE isn't really about the past. It's a barometer for what the market expects for the future. Okay, now let's look at that first engine and see how it can build some absolutely incredible wealth. This is the power of what we call PE expansion. PE expansion is simply what happens when the market collectively changes its mind and decides a company's profits are worth more today than they were yesterday. It's that multiple getting bigger, and it can create these explosive gains for investors that have nothing to do with how much profit the company's actually making. And Apple's own story is the perfect example here. If you go back to 2015, the market would only pay about 15 times what Apple was earning. By 2020, that number had jumped all the way to 25. And today, it's sitting at 31. That journey, that is PE expansion in action. To give you a sense of how people felt back then, one famous investor said that Apple in 2015 traded like a steel mill on its way out of business. Ouch. The market just saw it as this boring, low-growth hardware company. And that low expectation, it was baked right into that low PE ratio. And here's the real kicker. Over the last 10 years, Apple's earnings roughly tripled, which, don't get me wrong, that's amazing, but its stock price, it went up 7 times. That huge gap between the two, that's the power of PE expansion. Investors got paid twice, once for the company making more money, and then even more because the market had a total change of heart. But of course, what goes up can also come down. And that brings us to the dark side of our little formula, the really dangerous, wealth-killing trap of PE contraction. PE contraction is the exact opposite, right? It's when the market mood sours and investors suddenly decide they're willing to pay less for each dollar of profit. And here's the brutal truth. This can happen even when a company is doing everything right. Just look at what happened a couple of years ago. Between late 2021 and the middle of 2022, Apple was posting record profits. I mean, the business was an absolute machine. And yet, the stock price fell almost 30%. How is that even possible? Well, it was PE contraction. The PE ratio, which was flying high around 30, got totally crushed, all the way down to 20. So the company's earnings engine was still firing away, but that other engine, the market's valuation engine, it just slammed into reverse, and it dragged the stock price right down with it. So what causes this? Well, it's often these big picture things. Interest rates go up, which makes boring, safe investments look better. Or there's more economic uncertainty. Or the market just gets pessimistic about future growth. Any one of those things can squeeze that PE multiple. And it can happen fast. So there you have it. A new, much more powerful lens to look at any stock. You're not just looking at a price anymore, you're looking at the two engines that actually create that price. And this table really just puts it all together perfectly. You can literally see the formula playing out over a decade. Back in 2015, a PE of 15 times earnings of $2 gave you a $30 stock. Fast forward to today, a much bigger PE of 31 combined with earnings that have tripled to over $6, that's how you get a $200 stock. Both engines had to work together to give you that incredible return. And that brings us to the final and most important question that you should be asking about every single stock you own or even think about buying. Are both of those engines working for you? Is the company actually growing its profits? And is the market likely to keep rewarding that growth with a stable or maybe even an expanding PE? Because understanding that is the real key.